As a recession edges closer, we could be entering a life-changing opportunity. Inflation is reaching double digits, the cost of gas, fuel and food are at all-time highs. These big drops we're seeing in the market could be used as an opportunity for some to buy in when things are low. Even though things may seem bleak, remember it's only temporary. And here's why. On average, there's a recession every 10 years. After a recession, there's an expansion in the stock market. A recession on average lasts 18 months, and the average expansion lasts 39 months. Over the last 20 years, there's been significant crashes in the US which we can look at as examples. The dot-com bubble in 2000, the market dropped 49% over the 18 months. The following 5 years saw an expansion of 98%. The Great Financial Crisis of 2007 dropped 58% over 17 months. It then went on to increase by 400% the following 10 years. And more recently, the pandemic saw a decrease of 33% and recovered by over 100% over the next 21 months. So this shows us that despite the drops of 30 to 60%, the prices not only recovered over the long term, but they eventually went above the previous highs and stayed that way for longer. Yes, these are extremely tough times with increased living expenses and reduced earning potential. If you're able to find ways to save money, like I mentioned in my previous video, you'd have learned a couple of ways to have some extra cash. With this extra money, you can use it to invest in various assets. And if you're able to capitalize on options available, it could lead to opportunities allowing you to benefit both in the short term and in the long term. So in this video, I want to go over some of those assets that we could be investing in if we have the available cash to do so. And number one is stockpiling cash. In the build up to a recession, this asset class is something to prioritize. Now, usually just holding on to cash isn't the best way to earn more money over the long term. However, the reason it's on this list is due to its purchasing power. For example, at the start of 2022, Warren Buffett held 20% of his company's value in cash. He did receive criticism for not optimizing the returns. In Q1, he invested 50 billion into stocks, leaving 100 billion left over. Now, the lesson learned here is that having cash means you'll be able to deploy your money and invest when the crash does happen, and that's what he did. This lets you buy assets at a cheaper price and allowing you to benefit in the long term. Stockpiling your cash beforehand will improve your purchasing power when a crash does inevitably arrive. If you have some money set aside, you can use that to invest. But remember to make sure that you have all your debts paid off, you have some savings and an emergency fund. And if you want to learn more about this stuff, you can check out my previous video linked in the description. Number two is the stock market. The second asset on the list is investing in the stock market, in particular index funds. This is accessible to most people with an internet connection and some extra cash to invest. As we know, when a recession occurs, the stock market takes a hit and dips. But this could be the perfect opportunity to come in and buy the stocks when it's at a lower price. We know stock market expansions happen after a recession, so this one is a long-term strategy. It's something if you're willing to do it consistently over a long period of time, you will benefit. Now, as well as this, there are other strategies you should be using to get the most out of the market downturn. Firstly, is don't sell. You shouldn't be investing the money you need within the next 5 to 10 years. This should be your money that you're willing to lose or not to see for a significant period of time, because you have to invest for the long term. And the only thing you need is patience and consistency. Following a recession, the markets recover and you'll start to see an expansion in the stock market. Don't try to time the market because that never works. You need to use something called dollar cost averaging. Dollar cost averaging is a strategy where you invest the same amount of money at regular intervals. Regardless of the price or media speculation, successful investing is all about psychology, and the use of dollar cost averaging removes any emotion from the decision making. You should set up a direct debit which takes the money out of your account so you don't need to think about it and allows you to remain consistent. During the dips in the market, it can also be a good idea to allocate more money towards this because you're able to buy it when it's cheap. Take comfort in the fact that you're buying more shares at a lower price and you'll be able to reap the rewards when the market recovers. Number three is property and REITs. For this asset class, it could be something as simple as adding value to your home. For example, can you build an extension to your house or have some extra floor space? Or it could be things like improving the kitchen or the bathroom or the living areas. Changing small things like the carpets or having a fresh paint job can go a long way to increasing the value of your house. And these are really easy ways to get started. Any gains you make through refinancing or selling are tax-free and can be recycled. Another option is renting unused space. If you are in the fortunate position to have some extra space or even some extra land, you can rent it out or put it on Airbnb. And this allows for an extra income stream if you have a spare room that you're willing to rent out. Now, if you're not in a position to make home improvements or to rent out a room, you can invest in REITs, which stands for a real estate investment trust. Now, a real estate investment trust is a company that invests in different types of real estate. That could include everything from flats people live in, office buildings in the city, shopping centers, and even data centers used by technology companies. These are properties that would otherwise be very tricky to access. Owning shares in a REIT is a means by which you can invest in those properties, and because those shares aren't going to cost you hundreds of thousands of pounds, they're also a cheaper way to do it. REITs work in much the same way stocks do. Shares in REITs are usually listed on exchanges and can be traded by market participants. The great thing about a REIT is the low barrier to entry. Investing in property is very expensive, and the bigger the property, the more money you need. With a REIT, you can get exposure to a property and the benefits of collecting rent without the need of sumping up a big deposit up front. And the great thing is you can literally invest in REITs with a few pounds. REITs are professionally managed businesses that look after the maintenance of the property for you, so it takes away a lot of the stress of being a landlord or renting out your spare room. Number 4 is crypto. The final asset you could consider investing is cryptocurrency. This asset is extremely volatile and something you need to be careful about. Recently in the news, huge platforms like Celsius and Voyager have filed for bankruptcy, and there may be more to follow. It can be an incredibly risky investment, but the crypto markets have experienced a huge crash and it could go down even further. Whilst this is the case, there are always opportunities which you can take advantage of. When it comes to investing in cryptocurrency, you need to think about, or at least ask yourself, a few things. Firstly, you need to understand what you're investing in and why. If you don't understand it, it's best to stay away from it and not to invest blindly or because everyone else is doing it. The second rule, and this could be used for all investing, is that you invest money that you're prepared to never see again. The recent bankruptcy of Celsius, for example, proves this. And the third rule is to avoid investing more than 5 to 10% of your portfolio into cryptocurrency. You should try to make sure that crypto makes up a smaller proportion of your portfolio due to its volatility and the risk that comes with it. Now, granted all these rules are met, then you can approach cryptocurrency in a sensible manner. Bitcoin reached a peak of over 60,000 in 2021, and it currently sits at around 17,000. And Ethereum reached a peak of nearly 4,900, and as of today, it sits at around 1,300. If it again reaches its peak, which is a possibility, then that's an increase of over 200%. So this does show that there are big potential gains that could be made. If you risk a small amount of money into this category, you need to weigh up the pros and cons and see what's best. So if you understand and believe in cryptocurrency and you're prepared to potentially lose your money, then now might be a good time to start investing in this asset class. Recessions and expansions happen, and it's an inevitable part of the economic cycle. If you're able to invest during a recession and the downtimes, you'll be able to realize the gains and increase your wealth during the expansion period. It all comes down to your preparation, and you need to be ready to capitalize or at least be aware of the opportunities that are around you. And that could go beyond the 4 assets I talked about in this video, as there's lots of potential to make money by investing during a recession. Now, if you'd like to learn more about saving money, you might like to check out this video over here. Thanks for watching.